Good afternoon, everyone. Welcome to today's Wednesday market review. My name is Stock Darts, and we're going to do what we normally do on Wednesdays. We're going to go ahead and take a look at the four major market ETFs. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish analyzing the markets, we'll take a quick look at the U.S. dollar. We'll look at oil, gold, and silver, and then from there we'll move on to chart requests. So those of you that are in here, if you have a chart you want me to look at, feel free to type it into the chat, and we'll make sure to save some time for it. If you like the analysis you see here, you can always follow me on Twitter at StockDarts. You can find my videos on YouTube under the same name, or you could visit me at patreon.com/StockDarts, where I post weekly blog content, typically trading ideas and watch list stuff, and some kind of meta-analysis of how I'm approaching the market and how I'm trading each particular type of trade environment. Other than that, let's go ahead and get started. First thing we're going to do is take a look at the S&P 500 through the ETF SPY. Now, we've had a nice start to the week. It's been very interesting. We had a gap higher to start yesterday. Remember, we had Monday off, holiday weekend, so we had a nice long weekend. This is going to be a little bit of a shorter week, and we gapped higher, and then we kind of sold off. And what we ended up doing was closing the day kind of at the middle of the candle. Showing that buyers were willing to step in and hold at the end of the day. And so far it looks like we're forming something very similar to that today. Now, typically traders are going to look at hammer candles and say that those are bullish candles. They're not bullish when they're at the top of a range. They actually are indicative of sellers coming in and impacting price. Even if we end up closing strongly, it shows that there is supply at the current levels and that sellers are indeed trying to make an impact on the price action. Now, we're in an interesting spot right now, right? The market is starting to get pretty strong, especially when you consider the type of environment we're in. And I think that we're getting a little long in the tooth when it comes to our current rally. And the question really is how much further can we go? It looks like the NASDAQ wants to shoot for all-time highs, or at least kind of reach the all-time highs we reached earlier this year. And the other indices are kind of following suit and breaking through some pretty critical resistance levels. So it looks like the market just wants to erase the last couple of months and put the price action right back to where we were before this whole coronavirus thing started. And the question is, do we have enough demand to push through that? Or are we still really just exploring what should be the top of our range for the foreseeable future, particularly as we head into the summer months? I think it's more of the latter, but my opinion doesn't really mean anything. It's really what the market wants to do, and I will always go ahead and follow the markets regardless of what my personal opinions are. But personally, at the moment, it's difficult to trade this to the long side because there's just not a lot of reward left for the risk associated with a particular trade. So for instance, if we look at the S&P 500 right now, what do we really have to the upside? Or, we're not really looking at all-time highs. We're probably looking at somewhere in the 309 to 310, possibly a major wall of resistance up here at 320. But if you look into the downside, we've got a lot of room to the downside. And so I think at this point it's difficult to take a long trade and be excited about it and try to chase the price action at these current levels. Now, one thing I will say is that we have had a decent amount of consolidation above, just below the 295 level, which is actually a pretty critical price point, which we'll get into in a second. And so we had a nice little kind of consolidation, attempted a breakout. We even retested, and then these last 2 days, we're starting to establish a new breakout. So there is potential for this momentum to push the market further upwards. And for those that are looking for risk reward, you can always kind of piggyback off of this and say, well, you kind of manufacture your own risk reward by saying, well, I'll stop out anything below 294, 295, and then I'll play to the long side, in which case your risk reward becomes a little bit more palatable and a little bit easier to digest or to take, is because you'll understand that if we lose 295, that's a good chance that we're going to end up coming all the way back into the 280s. So you can make your trade a little bit easier to work with along those lines. Now, personally, I think we're getting into a market that's getting kind of tired. I'm starting to see some shifts in the behavior of individual areas of the market that I've been kind of following closely, and we'll get into that a little bit later today. But for now, I'm not excited about shorting just yet because, again, there's a lot of demand that keeps pushing this market upwards. We've got to basically a market that expects us to go back to normal. And until we have more news showing that it's going to be a while till we get back to normal, we probably won't have enough to dent the price action or make enough of an impact where the bears could kind of take over and start pushing backwards. Now, I'm not expecting, at this point, I'm not expecting a return to lows, but I do think that we are, at the moment, looking for an area of resistance that becomes too high. The price becomes too high for the bulls to continue to kind of buy. And we haven't really found that yet, and I think that's really the state that the market's in. Now, as I mentioned before, this 295 is kind of an important area. If we go ahead and look at a weekly chart, those of you that regulars have seen this chart before, but just in case someone's new here, or to go ahead and review it, 295 was an important price in the S&P 500 through the ETF SPY throughout most of 2018 and 2019. You can see that that was the ceiling of the price action for a good amount of time over the last couple of years. And then towards the end of last year, we finally started to break out through that range, and we spent a good 2 or 3 months, the summer months for the most part, June, August, September, and then we're eventually able to break out, right? And so this is a really important price point. And as we started to correct throughout the coronavirus thing, we sliced right through all these levels, through the top of last year's range, through the middle, through the bottom. And we had this strong V bounce, and we've made our way all the way back through, and right back through that range from the downside to the upside. So we sliced through 2 years of price action, both to the downside and to the upside, in a relatively quick amount of time. And at the moment are really just trying to break past it and say that, you know what, this price range was important, but we really do belong back where we were at the start of the year. And I'm not so sure that that's, if we're looking at our economy being closed down for an entire quarter, it's difficult to say that we're right back to where we were at the start of last year, in January and February. But that's where the market wants to take itself right now. And that's where we are, and that's why that 295 is a critical area, because it shows that the market is willing to come up and sort of test these levels that we only saw last year, at the very end of last year and at the beginning of this year. And that's where we stand right now. And, next stop is going to be all the way up here, 320, if things keep going the way that they've been going over the last few weeks. Personally, I think at some point we're going to get an impact on the other side of the board, and we're going to have the sellers push back. There's a lot of room now to kind of retest and not worry about coming all the way back down to lows. And so now it's just a matter of seeing how this price action works. And like I said, we'll go over this when we get closer to the chart request section. I'll give you some ideas of what's going on underneath the surface, why I'm seeing a little bit of different price action right now than what we've seen over the last couple of months, which shows that the market is expecting us to get back to normal. And it's really, the question will be whether do you believe that argument or not, but we'll get to that a little bit later. Now, as far as the key levels on the S&P 500, we've kind of gone over them, but just to kind of look at them a little bit more closely, excuse me, to the upside, we're clearing the 200-period moving average, which was the area that was just above 295. If we continue to hold above this with these two hammer candles and are able to kind of make our way through, well, the next key level is up here around 310, 311. You can see that when we first broke down at the beginning, or towards the middle of February, as at the beginning of this whole coronavirus situation, we really broke down quickly, and then we found support just below 295, right? You can see we came up, we closed right on it, and then we had one day beneath it that we just kind of gapped lower and then made our way right back to that level. And then we tried to make our way back through the 200. You can see we had this little rising wedge, and 2 or 3 days of price action was able to get it right back up, and we had that kind of reflexive bounce. And then eventually we broke down, and that's when things really started to head south fast, right? That's where we are right now. We've returned right back to the scene of the crime. We're right around that breakdown point. And that's the price that the S&P 500 is trying to get back through again. I expect significant supply and significant selling pressure as we make our way closer to 310, and even as we get just towards this 305 and the breakdown of this wedge. And more likely than not, we should stall out and probably head right back down and retest 295. And I think right now, the mode that the market's in is, well, we've cleared 295. We're going to figure out where the next level of resistance is, or the next potential ceiling for the price action. Should be somewhere up here in the 310 area to 305 area. Once we do find that and we pull back, do we hold above 295? I think that's going to be the next big question to answer is, are we going to fully establish that price action belongs above the 295 price point? And so that's really the critical area right now is 295. If we hold above that, well, then the market's going to continue to probe towards the 305 to 310 area. And if it can get through that, which I don't expect anytime in the next week or so, but if we do get through that, the next level is 320. And that, again, is a level that I don't expect us to push through anytime soon on the S&P 500. But that is an area to keep in mind. You never know what happens from day to day. If there's really positive news on a vaccine tomorrow or the day after, then there's a good chance the market's going to shoot up towards those levels. However, if there's poor news, then we're going to come back and retest 295. And if we lose 295, then that's where things get interesting, because as you can see, by the time price action gets back to the 295 area, we're going to have kind of a convergence of several levels of potential support. We have obviously the level 295. We have this ascending trend line that has supported price since pretty much the beginning of April. And we have the 20-period moving average, which is following closely behind. And if we sell over the next day or two, they're likely going to all converge right around that price. And if we slice through that, there's a good chance that we're going to make our way all the way back down into the 270s, not just the 280s, but all the way back down to 279, 278. 273, 274 is a really important level, and I don't expect price to fall back below that anytime soon. So that would be a major level of support if, for whatever reason, we do have a strong sell-off. And so that's a key area for us to watch to the downside. So major level to the upside is 320, which I don't expect to be breached. Major level to the downside I don't expect to be breached is 273, 274. Shorter term levels that are more important are about 310 and 295 and slightly below it if we have to come back and test the 20-period moving average. So somewhere in the 295 to 290 area. If we lose that, this 295 to 290, then I expect price to come all the way down into the high 270s. All right, so that's kind of my analysis of the S&P 500, gauging for any potential scenario. More likely than not, what's going to happen is we're going to kind of attempt to push upwards, and then really the key is, do we hold above 295 when we come back? As I said, you can see already with the two candles from the last 2 days, we're opening strong and we're finding sellers right away. And even though we're kind of rallying off of that and rallying off of this 295 area, we're really struggling to break past 301, 302 and get back into this 305, which was where we broke down from this wedge. And so the further we climb up, the more likely we're going to find even more selling pressure. And it's going to take a nice amount of pressure from the bulls to be able to overcome this little pattern here. This is an important area to really kind of overcome. But again, we've overcome more significant areas. 295 in my mind was even more important. And even when we kind of broke through this 274, we did it pretty with relative ease, which is pretty impressive for the stock market. So overall, again, I think the market at this point is anticipating a full recovery. I personally don't think that it's going to be that easy to recover, but the market is at the moment expecting that. And until it changes its mind, that's what we have to look for. Now, a broader picture, I still think that really what we're doing is finding a ceiling for the price action. I think that we're going to be range bound from here into, probably into fall. And I think that's what we're doing right now, is really establishing what the ceiling is. But until we see some selling pressure and we see a top confirmed, we have to just kind of keep rolling with the punches and keep kind of following what the stock market's doing, which of course makes it a little bit more difficult because the risk reward, again, is not really that great at the moment. Now, we have a pretty interesting change here with the NASDAQ. The NASDAQ has led the way for the most part throughout the last several months, and it is starting to show some signs of weakness. You can see if we look at the four major ETFs here, it's the only one that's red today. Yesterday we didn't have a hammer, we just had a full sell-off, and today we do have a hammer candle showing that buyers are still willing to step in, but we're starting to see some price erosion, or some erosion in the price action in the Qs. It's not completely unexpected. After all, at some point people do need to take profits, and I think that's part of what's happening right now, is we're seeing some profit taking. We're also seeing money rotate out of some of the names that have performed exceptionally well over the last few months and into some of the more beaten up names that still have room to run. So what we have is a market that's starting to, I don't want to say it's running on fumes, but we're reaching a point where the strongest names have kind of reached prices that they can't push through, and so money's rotating out of them and going into some of the other names that have not performed as well, just people looking for return. I think that this often happens towards the later stages of a rally. That's another reason that I think that it's not a great idea to try to go long too much right now, because it's, I'm seeing signs of money rotating towards weaker stocks, which typically happens towards the end of a rally. So, again, we weren't able to push the new highs. It would be very, very surprising for the market to make its way to new all-time highs, even on just the Qs. No matter how well a lot of these tech names have done, it'd be very crazy to just kind of slice right back up to new all-time highs, and just kind of leave this entire coronavirus pandemic in the rearview mirror. So, a lot of selling pressure to be expected. Now, I do think the NASDAQ is still attempting to make its way up and at least touch all-time highs. And there's a very good chance that we do that before we have a stronger correction. It might not happen, but I think there's a pretty decent chance that it does happen. And there's probably going to be a kind of snapback and attempt at a bounce here from some of these tech names in the near future, if we don't get some bad news to turn the market right back around. So keep that in mind. Don't get excited. Don't chase the price action if the Qs make their way back up into the 235, 236 area. Again, I would consider that to be probably the end stage of this particular rally, which has been a very, very impressive rally. When you look at it from the perspective of the Qs, we've gone almost in a straight shot from 170 all the way back up into the 230s. So this has been a really incredible recovery from the market. And like I said, I don't expect us to just kind of, go back to where we left off and start climbing back through new highs. I think that we're probably going to be range bound, which means that we are approaching what is probably going to be the ceiling of our range on the Qs. Now, key levels are a little bit trickier to figure out here. Obviously, all-time highs is a key level. Just below it, where we sold off yesterday, is kind of important. We are at an okay support level here around the 20-period moving average. I mentioned last week and the week prior to that the 20-period moving average would probably be the first level of support for the Qs. When you have a name that's trending this strongly, a lot of times it just pulls back into its moving average rather than previous levels of support. Now, horizontal support, the real key level here is 217. That would actually probably coincide with this ascending trend line if price were to come back to it over the next couple of days. And that would be the next or the real key level of support. However, with the Qs, as you can see with today's price action, the 20-period moving average is the first avenue of support, and that's where we found support. And that's where the buyers stepped in and have actually pushed price up pretty quickly, going from 223 all the way up to 227. So, a quick 4-point bounce on the Qs, just as it came up towards this 20-period moving average. If we lose the 20, I expect price action, like I said, to come back to 218, likely meet this ascending trend line, and I don't expect it to fall below that right away. I would expect buyers to step in and support price action there, and wait for the 50-period moving average to come up and meet price, rather than a fall back through. If we do fall back through some reason, then expect the 50-period to kind of support price. But more likely than not, from here to next week, I would expect price action to remain somewhere between 218 and our recent highs around 233, maybe even a little bit above it. And that would be kind of where we would expect price to behave. That's part of what makes trading this area right now kind of difficult, is that the price action's kind of in the middle. You've got 10 points to the downside and about 10 points to the upside, and we're right smack in the middle of that. And so, that's part of what makes this a tough week to recommend trades and to trading ideas, is that there's, at this point the risk reward is really not that great to the upside, and it's really not that great to the downside, depending on what name you're looking at. There are some areas of the market that are pushing up into clearer resistance and might offer better short opportunities, but those are the names where the money and the price action is kind of rotating into at the moment. So we need to wait to see that kind of strength dissipate. Now, you'll also notice the Qs are kind of stuck in this little gap here, and that's part of what's going on here. You can see that lines up almost exactly with the 20-period moving average. That's right where we found support. So again, it just shows the relentless march as the buyers continue to push through all these critical levels that were holding up the NASDAQ prior to this, and then we're going to become potential levels of resistance as we push through. And so that's another key area, is this gap. Again, clearing that gap shows that the market expects price to, or behavior to be right back to where we were at the heights of February. As you can see, yesterday's price action, 233. If you look at where that is, that's right when we first started selling off because of the corona pandemic. And we came back and tested that yesterday. Probably, like I said, going to be a ceiling for price action, but we'll wait and see what happens as we close out this week. I think it'll be important to see how we move into Thursday and Friday, and whether we find more sellers or whether we try to blast right back to these levels and through them. And it'll be key. And like I said, we'll get into a little bit more detail a little bit later on, but we'll see what some of these names under the hood, some of these tech names that have done well, how they're behaving right now, and we'll see a little bit more of why things are starting to shift a bit in the overall markets. Now, if we look at the Dow Jones, we see a picture much different from what we just saw in the Qs, right? Nowhere near all-time highs, not even near our 200-period moving average. However, we're seeing some strength today, and over the last few days on the Dow Jones and on IWM. You can see the S&P 500 up about 0.5%, the Qs down 0.5%. The Dow and IWM are up about 1%, 1.5% for IWM. So some of the weaker names that have been beaten up are again starting to rally, and I'm seeing that a lot in some industrial names as well, and that's reflected in the Dow Jones. You can see the Dow Jones starting to climb above 250. Again, one thing to note is that we are clearing our previous price range, right? So this is bullish. Despite the fact that I feel like there's not a lot of upside left, the market is doing something kind of bullish right now. And that's important to note, right? Because again, my opinion is only one thing, and it's rather insignificant when you compare it to what the markets are doing or what they want to do. Now, risk reward again is not that great. We've got about 4 or 5 points to the downside, and we've got maybe 10 points to the upside. To the so 2 to 1. I mean, that's all right. Risk reward was much better 2 days ago, but at that point it was really difficult to take a trade on that, and we had the gap up over the weekend. It shows again the money's rotating towards some of the weaker names, and I think that's something that we have to keep in mind. And I want to see how this plays out over the next week before I go ahead and trust some of these weaker names. I might be a little slow to the party, and maybe this rallies up into the 200-period moving average and I miss out the trade, but I'm all right with that. One thing I pointed out, it's been a few weeks since I mentioned this, but let's go to the weekly chart for a second. Actually, I want to go to the monthly chart for this. There are times in the market where you want to push the envelope a bit and you want to be aggressive, and there are times in the market when you want to be careful. There are times when the market's very easy to trade, and despite what a lot of amateur traders might think, and there are times in the market where it's very difficult to trade, no matter how good you are, or even if you're a professional. So I'm going to take our little rectangle tool here, and you'll see 2012 to 2013 was a really really easy time to trade the markets. The market just basically went up every single day, or almost every day, and just kind of climbed steadily. Never really had any strong sell-offs. This is the kind of environment where you want to push the envelope. You want to trade, aggressively. You want to take advantage of trades to the long side, and then eventually the market shifts, right? And you get into these consolidation ranges, these accumulation stages where these bases, and this is when the market becomes trickier to trade, because again you have a reversal coming in, you have a lot more selling pressure, and you have range bound price action. Now, range bound price action in itself is not that difficult to trade. So once a range is established, this is not that difficult to trade, but it's it is more difficult than the straight up easy uptrends, right? And so really the really difficult ones are these inflection points when you have a change in character in the market. However, once again, you have these steady trends, right? What we saw in 2017 and 2018. This is a very easy market to trade because, again, the market is going in one direction. There aren't any substantial price swings, and everything just kind of goes in the same direction. Contrast that to what we've seen over the last, first let's do what we saw from 2018 and 2019. Again, we had a shift in character. We had an inflection point and the market started changing and going back and forth. In the beginning, that's a very nearly impossible to trade easily or well, right? And then as the range starts to hash out, it becomes a little bit easier to trade. And then eventually we get the rally, which is usually when it's a lot easier to make money. Now, look at what we have right now. We have a big slice through all potential levels of support. Then we have a slice right back through to the other direction. These are not easy times to trade for anyone, right? And so during these moments, it makes sense to be a lot more cautious and to not necessarily chase every idea that you think is going to work out, right? So, in my mind right now, it's much easier to be safe. It's much easier to trust the ideas that I know have worked well over the course of the last 2 or 3 months. For those of you that are regulars, you know how we've approached this market. We've traded names like Netflix, names like Amazon, that have been mostly, for the most part, insulated from traders or from workers being shut down and trading at home. And we've stayed away from names that have been impacted severely from the workforce basically relegated to working from home or not working at all. Once that trade stops working, to me that's a signal to kind of step back and try to figure out what the next stage is in the market, right? And I think that's what I'm seeing at the moment. Like I said, it could be profit taking, but this is a slightly bullish breakout. It's not impressively bullish, right? It's nice that we broke above a key resistance area, but look at the volume. Look at the candles. Again, these hammer candles, these shooting stars, these aren't impressive breakout signals. So at the moment, I'm not inclined to buy this at all. It's easier to be more cautious at this point because the market, again, is in a pretty big state of flux and turmoil. And overall, I don't really trust the price action enough to go ahead and try to play long. Now, could I be wrong? Could this thing shoot straight up to the 260s? Could a lot of these beaten up names continue to rally? Certainly. Will I care? No. I've done very well over the last couple of months. I've, for the most part, have been able to kind of ignore a lot of the serious hits that a lot of traders have taken during this market. And since the beginning of March, for those of you that read my Patreon or subscribers, you'll know that we've been on the right side of the market. We've been able to make our way back through and recover a lot of our losses that may have occurred in February pretty quickly. Part of it, of course, just because the market's doing well, but part of it because we picked the right horses to kind of lead the way forward. And I think at this point, I'd rather be more cautious and, wait to see how things shift and if they do shift, because again, I'm not so sure that our market, our economy is ready to get right back to the same, the normal that we had back in February. So, it looks bullish, but I'm not buying at the moment, and I'm not going to gamble on this. Now, what happens if I'm wrong? Well, we make a move back up to 263, 265 or so. And at that point, we find another major level of resistance that likely will be a point for the market to possibly reverse. You can see, again, if you look at this, let's change that color, or this wedge here, very similar to what we just saw on the Qs. We're not there yet with the Dow Jones, and that's going to be the next level to test. And we'll see what happens if we get to that stage. Again, that's going to be right around the 200-period moving average, and that's going to be kind of a critical point of resistance. Now, to the downside, we do have nice levels of support. So just like the S&P 500, we're trying to hold above an important level here. If we fall below that, we've got a lot of support, and I don't expect price action to fall below 233. I think that's going to be a major area of support, and at this point should be the bottom of our range, at least until the next month or two, until we start to see how things really play out as we move into the summer months. Now, finally, we have IWM. And again, you see the nice breakout. Again, on low volume. but it's there. And two hammer candles, which again I don't think are really the candles you want to see on a breakout, but nevertheless we are probing through. We're able to fill this gap. The good thing to note here is that we are seeing money rotate into small caps. So traders are beginning to accept risks, and that's a good sign. That's a positive sign, regardless of whatever negatives I might just have stated about where I think the economy is, and what we're seeing with the price action. This is actually a healthy sign. Regardless of whether it ends up being a signal that we're at the end stages of our rally and are ready to start correcting. Regardless, it's nice to see buyers step into the small caps and are willing to assume risk here and aren't just terrified to try to go long anything. So this is a positive sign. Again, for those of you that maybe don't understand what I'm talking about here, typically the most volatile assets of the four ETFs that we're looking at right now, the four major markets, the small caps are the most volatile. They're the ones that have the most risk associated with them. And so they will be the ones that when a market is completely fearless, these will be the names that move the most. And when a market is terrified, these are going to be names that are hit the hardest, because where people are going to avoid right away, they're going to avoid all the risk. The first place that you're going to leave is the riskiest asset. You'll leave your money parked in the safer assets that you might find in the S&P 500 or the Dow Jones. So typically IWM is going to be the first leg down when you have a fearful market, but it should also be the first leg up in a really strong market. We haven't really seen that over the last few years, but it is nice to see, at least in the short term, buyers willing to accept risks and are pushing the small caps back up. This is really necessary because, again, the small caps were threatening once again to head back to lows. You can see what happened not that long ago, back in the beginning of May, or actually not even the middle of May. We actually lost a pretty critical level around 125. We came back and had to have a major test of our kind of trend higher since March, and our 50-period moving average, and a bunch of other key areas. And this was a really important kind of inflection point here, and a nice reversal that showed that buyers are willing to take risks. And so we've made our way back up. We're kind of coming back up to the 200-period moving average. Now, if you look at the weekly chart, you'll see just how weak IWM has been and the small caps have been, and the difference between the small caps compared to the other indices, right? We're not really ready to test the top of the range from the last couple of years. You can see it's been a very sloppy move back and forth. Some key areas, of course, have been this 145 and about 160. And we're kind of getting back towards the bottom of that, around 145. And so that's going to be another major level of resistance as we come up. So as you can see, a lot of these markets, even though we're seeing kind of bullish patterns in the short term, if you're looking at breakouts of resistance, what I'm also seeing is that despite the fact that we're breaking out, we're not that far away from even bigger or more significant levels of resistance. And so, it makes it difficult to try to get excited about playing to the long side here for all the different reasons that I've just stated. So for me right now, I am still taking shots to the long side if I see them, but I'm being very cautious, and I'm making sure that I only take the absolute best trades. So to poker analogy, right now I'm only going to play stuff like pocket aces or pocket kings. I'm not going to kind of gamble with like a 7-8 or something like that. And I'm just going to make sure that I play only the absolute best hands. And really, my focus right now is looking at some of these weaker names that are rallying and identifying levels that I expect, that I'm hoping will be good potential reversal areas for some shorts in the next couple of weeks once the market does eventually find its ceiling. And again, I don't think that we're that far away from this market finding its potential ceiling or its roof. And at that point, we should get some selling pressure. Now, it could be that the selling pressure is very minimal, and we just kind of base out and trade sideways right below resistance, or it could be that we have stronger selling. And if that's the case, then the short trades will work, but we'll get to that when we get to that. But right now, as far as what I'm doing, I'm watching some weaker names and identifying levels of resistance to see what happens when we get there. And, to the long side, it's difficult right now unless you find names, which we'll get to in a little bit, that are instead going backwards and finding support levels. Which maybe if the markets continue to rally, then they'll kind of, money might flow back into some of those names. And we'll get to that again, like I said, in a little bit. Now, again, for anyone that has any questions, you can always type it into the chat. I'd love to see what your guys' thoughts are. If you agree with me, you disagree. If you have any questions on some of these patterns or a different stock that you want me to look at, feel free to type it in the chat. It's always much easier for this when I have some interaction with you guys. It makes it easier to kind of branch out and explore new ideas rather than a lot of this analysis. For those of you that are regulars, we go through this every week, so it's not that different from what we saw last Wednesday. All right, so let's take a quick look at the U.S. dollar. And as you can see, volatility continues to kind of contract. We're seeing things calm down a bit. We found a nice little range here between about 26.75 and about 27.25 or so. Right back to the bottom of the range. You can see we had a nice little bounce last week, as expected, but the start of this week, we kind of gap right back down and are right back down at support. We're seeing some signs of the U.S. dollar losing this level and possibly breaking down. We'll see how that, we're going to take a look at a couple individual currency crosses and see what happens there. So Wes, I see you're doing the same as me. You're just playing the waiting game. Yeah, like I said, same as me. I don't really see anything great right now, and I find it easier to be cautious. You don't have to take a trade every day. For those of you that are trying to get into trading, or even those of you that have been trading a long time, you don't necessarily have to trade every day. And if you do, sometimes you just day trade, in which case the overall direction of the market doesn't really make a difference. That's a good thing, by the way, for those of you that learn to use technical analysis. You could trade any instrument in any time frame, so it lets you kind of not get sucked into having to try to buy stocks at a time when the market's not really conducive to it, because you can always just day trade, or you can move, you could kind of shift over and look at Forex, like I do from time to time, and look for different opportunities in different areas. Now, that being said, like I said, the dollar is it's right at a level of support, but it is starting to struggle. We can see it a little bit more clearly when we look at some of these currency crosses. We look at the euro versus the U.S. dollar. Now, this is going to be inverse. Up is good for the euro, so down is good for the U.S. dollar. And you can see, again, the U.S. dollar has lost some ground versus the euro, and we're right back to a pretty critical area here, around the 200-period moving average. Now, we did have an important break of what was a bearish trend. And you can see we're starting to make headway here with the euro, and the euro wants to break the 200-period moving average and start to make its way higher. If this happens, that pretty much guarantees that the U.S. dollar will lose that key level on the UUP index and lose ground versus these currencies. And I think that's where we're headed, but we're not really there yet. But you can see, again, some chinks in the U.S. dollar. You can see the U.S. dollar losing momentum versus the euro as the euro starts to make its way back up and through some pretty important areas here. If we look at the U.S. dollar versus the Canadian, again, losing ground, a lot of this because of oil, lost a pretty critical area here and broke down. That's a pretty significant breakdown. The next step is probably going to be an attempted bounce to come back and get back into that range, and we'll see if it gets rejected there, then we're looking for another leg down and much lower as it maybe makes its way back down to the 135 area. If it gets back into that range, then it'll probably chop back and forth for a bit longer, waiting for oil to do something, which is something that's going to be important as well, which we'll get into in a second. And then finally we have the US yen. And interestingly enough, we're kind of stabilized here. Japan just had a new stimulus package that they proposed, and that's likely going to devalue their currency. So there's a decent chance that the U.S. dollar actually holds versus the yen, even if it loses ground versus the other two. You can see it's still kind of maintaining this base around 107, 108. If it can break back above this, there's a decent chance it makes its way towards the high 108s into 109. If, for whatever reason, the U.S. dollar loses ground even against the yen, then expect this 107 to be the key area for it to try to lose. If we lose that, then we're going to head back down into the 106 area. So those are the three currency crosses I look at. Again, showing weakness in the U.S. dollar. If we see a turnaround and we see the U.S. dollar gain strength, that might mean the market starts to lose a little bit of ground as well. So keep that in mind. And then finally we have oil. Obviously the crude chart is going to be difficult to look at for a while because of this explosion, this crazy move that happened at the end of April when oil traded negative. So what I've been doing lately is I'm just looking at the 4-hour chart. What we do is we just erase that day. we take a look at the most recent contracts. And one thing to note, again, is take a look at oil and how it's basically gone straight, not straight up in a strong, crazy rally, but it's behaved in a very stable manner and has slowly kind of gained value, showing that, again, the market is expecting us to start returning back to normal and start looking for, start to consume more energy. So this is Exhibit A, in this idea that the market is expecting our economy to get back to normal. If you look at what oil's doing, you can see that it's basically pricing in an increased demand for energy. This last Tuesday was a critical day. Last Tuesday was another oil expiration day, and the price of oil didn't cave in. It actually held very steady. So, at the moment, the market is expecting people to start using more energy, to go back to work, start traveling. This is a key area. If you want to figure out exactly when we're going to have a shift in market, I think that once we start to lose price on oil, I think that'll be kind of one of the turning points. I don't think oil is going to be the reason the markets go down, but I think once we see oil prices start to go down, it'll give us an idea of just how much the idea that demand is going to come back on energy is not necessarily incorrect, but we'll see the other side of that coin, right? At the moment, we're expecting demand to just keep going up and up and up. At a certain point, we'll realize, well, this is the new normal. There's still going to be people working from home. A lot of major companies have already gone out and said that their workers can work from home indefinitely, or for the rest of this year, for the rest of next year. So we're not going to get back to the same energy consumption that we had prior to this. And at a certain point, we'll hit a ceiling, and the price of oil will come right back down and start to figure out where its point of equilibrium is, right? There's a lot of supply out there that hasn't really been hit yet, and once we start dipping into that, it'll again lower demand, and we'll have a price drop. When that happens, more likely than not, we'll see the same sort of scenario playing out across the board, where we'll see a lot of these names that are, at the moment, the market is pricing in like they're going to recover back fully, and more likely than not, what they're going to do is recover back maybe half to 75% of the value they had prior to this, because you don't just erase an entire quarter's worth of profits and expect us to get back to normal right away. It's going to take a while for people to go back to work. It's going to take a while for people to feel safe enough to really travel. There are people that have already started to go back to the beach and are willing to go back to restaurants, but there's a major part of our population that's not ready to do that and is going to do so in a limited manner. And even those that have already kind of come back out and done it, once the novelty wears off, they might go back into the routine of playing a little bit more safely and staying at home. So I think that's one of the key things that we need to watch going forward. But as you can see for now, what we're seeing is a market that's pricing in increased demand and really a return to normalcy. Now again, we're not really back to normal. If you look at it's going to be hard again because of that crazy wick. Well, it's impossible really, but price action for oil normal would be in the 60s, so we're still quite a bit away from oil getting back into the 50s and 60s, which is where it was before. Alright, so that is the major markets and oil. Oh, you know what? I didn't look at gold and silver. Let's look at gold and silver real quick. Again, anyone has a chart request, I'd love to see what you guys are looking at. Maybe you found something that I couldn't find. But here's gold. You can see gold was not able to break out and has lost ground and has come right back down and is getting pretty close to a pretty key area of support. I expect probably demand to kind of come in here, and I expect this area to hold. And this is probably not a bad spot for someone looking for a potential long trade on gold. Not yet, but as we get enough reversal and we get signs of buyers stepping in here, we might have a decent long entry there. And that might be something that's worth paying attention to, considering how few opportunities we're getting right now. Silver is actually doing better than gold again. Trading a nice little bull flag here. It's kind of difficult to go ahead and recommend a trade at the moment, though, because of where it is in that bull flag. But something to keep an eye out. Now again, this again shows that the market is starting to price in a recovery, as silver's making up a lot of the ground that it lost to gold. Silver again used more industrially than gold. Gold is mostly just a store of value. So silver lost a lot of ground when we weren't expecting it to be used at all. And now that it's starting to recover, again, it's market pricing in the fact that we're starting to get back to maybe not a full normal, but we're starting to get back into a little bit of a normal state. And so it's coming up and making up a lot of ground as it tries to catch up to gold. All right, so like I said, if any of you guys has a chart request, feel free to put it in. I'm going to elaborate a little bit more on this idea that I've been mentioning of this rotation of money from some of these areas like Netflix. This is what I discussed this in detail in my post yesterday on Patreon, and so my members got a little bit of quicker access to this and more detailed access. But if you take a look at stuff like, what were the names that you would consider to be kind of the representative state of these companies that we've been trading that have been kind of insulated from our workforce staying at home, right? Netflix, people stay at home. They're gonna be able to. They can still use Netflix. And take a look at what's happened over the last week. Huge sell-off, a lot of selling pressure. Could be profit taking, or it could be a change in character in the market, right? Look at Amazon. Amazon holding up a little bit better, but again, you can see the selling pressure. You can see the change in character. Take a look at Zoom. And what are we seeing here? Again, this is not mirroring what we just saw in the broad market indices, right? We're seeing a loss of momentum. Look at some of these other names like Activision that have also benefited from people staying at home, right? Big drop over the last couple of days. Look at something like Peloton, another one of these poster children for this sort of economy, and again losing ground, right? So we're seeing a lot of these stocks that were doing really well finally seeing some chinks in the armor. Now, this could be indicative of a major trend shift, or this could just be profit taking, and these names could be offering us opportunities as they come up and hit support levels, right? So that's one of the things I'm watching, is how do these names behave as they hit support? Is this just money rotating out of this because we're at a ceiling, or is this really a change where the market expects these names to do significantly worse? One thing I want to point out, most of the names I pointed out, maybe not Peloton, maybe not Activision, but stuff like Zoom, stuff like Citrix, Amazon, these names were already indicative of the future of where we were headed in the workforce, even before this whole coronavirus thing. So I don't think that these names go away. I don't think stuff like Citrix, stuff like Zoom, stuff like Amazon, they're not going anywhere. And this might be just buying opportunities once we find support levels for these. Because again, even if we have our workforce go back to work and everything goes back to normal, these names were already the strongest of the strong even before this whole thing, right? So don't expect these names to just top out and crash. They're still going to have a lot of business. They're still going to have a lot of demand. But I do want to point out in the short term, we're seeing a big change in character here. And if you take a look at some of the areas of the market that have really struggled, they're gaining ground and they're breaking through some key levels. Here's IYR, which to me was a stock that we looked at it last week, and it was at a very big inflection point where it could have had a bearish move or a bullish move. It ended up resolving in the bullish side. You can see it had a nice little break of the trend line and then the two gaps this week. Again, shows that the market is expecting us to get back to normal. The real estate is going to start performing better. I think Visa is a good proxy for our economy, right? And you can see the market is pricing in a recovery. You can see Visa's been climbing pretty steadily. And so you can see some of these areas of the market. And again, we can look at maybe some industrial names, right? So maybe take a look at Honeywell. And again, it shows that the market is starting to give these names a little bit of a breather, and they're starting to rally because the market thinks that we're getting back to normal. Now, again, these names are nowhere near their February prices, so the new normal is not necessarily the same as where we were in February, but it's important to keep in mind that money right now is rotating out of a lot of those darlings that were doing really well, and into some of these heavier hit names that have really struggled, right? Take a look at, say, it's another one we could look at, maybe, say, an airline, right? And you can see the airlines, again, maybe not, you can see they're beat up pretty heavily, right? And so the market is still anticipating bearish behavior on them. But again, seeing a little bit of a rally. Another name like the airlines, some of these realty stores, look at Macy's, nice breakout over the last couple of days and starting to make its way upwards. Now, these again are names I'm not that excited about playing to the long side, despite the fact that they are finally getting some bullish momentum, and they do have room. Like that's one thing I want to point out. Macy's has been closed down for an entire quarter. They're not going to get back to normal anytime soon. But again, normal is way back up here in the $16, $17 range. There is room to the upside here. But I'd rather stay away from these names because the overnight risk is much stronger on these. And I'd rather wait for them to hit their resistance levels. And once we identify what the new normal is, then we can say that's going to be the top of their price range, and I can play short from there. So that's kind of my game plan right now. Some of those stronger names that are pulling back, I'm going to look at those for potential buying opportunities, and some of these names that are doing better now that I think are still weak, I'm going to look at potential selling opportunities once we hit a wall. I'm not going to jump in too early, but just giving you an idea of where we are and what the market is pricing in and what the market is looking at. And as you can see pretty clearly over the last week, that the market is expecting some of these names to start recovering better, and conversely expecting money to flow away from some of these areas that have done well as people get back to work. All right, so those are some of my ideas. Ray, you have a couple stocks you're looking at. You say these are just tiny plays. All right, so you got a vaccine play. There's been a lot of potential trading in these vaccines. This is not my strength. This is one area that I'm definitely not very good at trading, is these kind of news-driven plays like vaccines. So we'll see what we can do here. A lot of these names are driven very strongly by news, so it makes it harder for them, harder for technical analysis to work well on them. And I think that's part of the reason why I don't trade them very well. But as we can see here, VBI had a very nice explosion from $1.30 all the way up to $3, and it came back, and you can see today it found support right around $2, which was a pretty key area here. You can see it was resistance, which eventually now should turn into support. So I don't know where you bought this. You had a buy-in at 198 this morning and it hit. Okay, so you had basically almost a perfect entry as far as price level goes. All right, so you're in. Well, Ray, I think you have a good entry. You have a good stop, which is today's lows, and you have a target, which is all the way up here in the 270 to 290 range. So right now you're doing good on it. There's a nice little intermediate level here around 223, which is right where it's trading at the moment. And that's going to be a nice little spot where you can look at. If you want to abandon this trade, if you get nervous on it, that's a spot to look at. But for now, I expect this to probably make its way back up towards the 250 to 270 range. And I think at that point it becomes a little bit more a question of where you exactly want to take profits. If you want to wait for 3, or if you want to try to maybe scale out. I would probably start to scale out as this thing hit 250, and then keep maybe 250, 275, and then hold some, looking for a move past 3. Obviously, your stop out point is anywhere around the 198, which is your entry to 189 or 188. And if you're really aggressive, you could just stop out if it loses 220. But that's really close to right now, and I think it's a little early to call that as an area to stop out. So good job on that. You were very aggressive with the entry. Normally I look for reversal patterns, but I would have missed this. But that was a good entry for you, and at the moment this is working pretty good for you. I don't know any of the news on it, so I'm not going to comment on that. This is actually very interesting. So this is a rare earth minerals, right? So this again probably do industrial stuff. It's an OTC. Was the last one an OTC? I didn't notice. No. No. See. Okay. I'd be a little bit leery of this. It's doing really well, but it's an OTC, which scares me a little bit, and it's an industrial metal, which has done well despite what's going on in the market. So I don't know. I don't know what to make of this one. I guess you've asked me for this before because I have some trend lines on here. You can see this dollar, basically just below $1, is a very critical price point. It broke out at a real strong move. The problem with it right now, Ray, is that we're seeing a very nice explosion on heavier volume, right? But this has happened before, and it's reaching a price that's going to be difficult to sustain. You can see a lot of selling pressure came in today, and it made its way all the way back. Now it did get bought up pretty quickly. You're in at $1.90, no, at 95 cents on this. Okay, so you're in at 95. You're in at the perfect area. I think with these, you might as well just hold it. I would maybe take profits on part of it. Oh no, okay, it looks like we froze again. I think this happens sometimes as these streams get a little longer. Um, it looks like my streaming software broke down again. Um, so I can't. So Ray, I guess just look at audio for this. The TMRC. If you got it in 95, that's a great entry. And where it's at right now, you probably want to take partial profits, but just hold. You can hold the rest because again, we got a big volume explosion on this, and it looks like it wants to make its way higher. Okay. Oh, good. Okay, we got to it. So anyway, Ray, yeah, you can see 95 cents, which is your entry, is a really good spot, and should be a good level or a good floor for it. But that's a long way from where we are right now. So if you haven't taken any profits, you probably want to take partial profits somewhere around this price because again, 150 is pretty important. That was the previous highs, and there was a lot. It got knocked down pretty good today. And so there is going to be selling pressure around this price point. So if you don't want to take profits yet, maybe trail a stop. And if it loses 150, you can start to stop out there. But you probably want to hold some looking for more. It's an OTC stock, so you never know what's going on with these. But sometimes these names have really explosive price moves as more people learn about them. Okay. And the last one you were looking at, I think, was CYCN, right? Hopefully we get the chart to show quickly. Alright, CYCN is in a different place. I think overall this is not that bad either. It's still a bullish chart. Alright, so we have two interesting chart patterns. One, we had this nice cup and handle, right? This was a really nice cup and handle. And we had a nice breakout from that. And then really, no fault of its own, all of a sudden we hit the coronavirus thing. And that's when this thing broke back down. Now you can see, unlike the rest of the markets, this didn't really lose that much ground. Now again, it wasn't trading at all-time highs or anything, so it didn't have as far to fall as maybe what a lot of the markets did, but you can see we kind of came back down and actually held above the previous lows. And then we had kind of a double bottom form, right? We've got to move back to 230 or 240, back to 360, back down to 230, and then back up. And now we've had another breakout back through there, right? So I think overall this is a bullish chart. Your entry is not very good. It's dealing with a kind of an important price point here. Oops. So if it breaks past this, then it's going to make its way back up to 5, and right around the 200 period moving average, and then maybe even make its way back up to 6. So there is potential bullishness here. However, at the moment, it's struggling at a pretty important price area. And again, this is right when we started this whole drop in the whole coronavirus thing, right? We started in the middle of February. We came back, and that's where this thing is right now. It's right where we had that initial bounce to try to, that reflexive bounce from our first drop. And that's where we are, very similar to where a lot of the markets are. So this is going to be a very critical point for it to try to overcome. If it can overcome it, then it has room to the upside. If it can't overcome that price, then it's going to make its way back down, probably down to 360. So keep that in mind with this trade, okay? Because your entry is so close to the breakout point. If it has room to the downside and significant, from 420 all the way to 360 before you really hit a support level, okay? And that's really where the support level is down, all the way down at 360, which would make a much better entry than 420. This entry will be much better for you if this thing can break 440. If it can, then I think you're in good shape and it can make its way back up, okay? But this one is still up in the air a little bit, okay? Overall, though, Ray, I think those three charts, none of them are really egregious or anything. Nice entries on a couple of them, and hopefully these things work out for you, okay? All right, folks. I think that covers it for today. If anyone has a chart request that they didn't type in that maybe they want me to look at, maybe you don't want to do it in public, you can always just message me on Twitter, and I can send it to you through there. Or you can visit us on our Discord, and I'd be more than happy to share that information with you there as well. Um, Other than that, I hope you guys have a good rest of this week, and we'll meet again next Wednesday.